Happy Friday, legends. I'm going to put together this quick video today just to show you what is happening with the current price action. The options have expired now, thankfully. This fake move here in Asia to the upside, that would have been the final trap for options because the options expired at the UK Open. So that means that we're now free to have a look at the follow through and what potential trade setups there are for the day. Don't forget that today is Friday, which is when the weekend trap is formed, usually during the UK session. So we're going to talk about that in this video. And we also have some news events coming up. So if you're new here, welcome. If you are returning, welcome back. If you're from the TTC tribe, big shout out to you guys. Killing it in the Discord as always. Now let's get into this current price action. I am on the 5-minute time frame. The reason that I'm on such a small time frame is because of this peak formation that has been formed. And what I'm liking about it is the stopping volume candle right into a higher time frame vector zone, which is this shaded area up here. And this blue line that you can see right here is 31,197. That was a prior high level liquidation zone that price took out during Asia today. So that's actually gone now. And the remaining blue ones that you can see are new high level liquidations that have just come in. And they are taken from high block, these areas here. So I've just marked out the highest spikes above the current price and also the highest spikes below the current price. These are important to us because this is what the market maker is going to come for in their attempt to collect contracts. So what we have a potential of happening right here is we may be in the midst of an M formation forming. It hasn't formed yet because we don't have a second side of it yet, but we do have a potential first side, and now we need to look for the second side if we believe this is going to go down. Now, the reason that I'm open to a potential pullback from here, A, is because of the weekend trap that I talked about. B is because on higher time frame, like even the 4-hour time frame, we can identify that we've already had our 3 levels. So we've had a rise 1 here, a rise 2 here, a rise 3, and this is where a possible 4-hour M could be forming right now. But I don't want to take my entries on the 4-hour because it means I have to have a super large stop loss. If I know what's going on macro, then I can go to the smaller time frame to get myself a really good entry and not need such a wide stop loss. So if you know where you are in the formation and you believe that a reversal should be coming soon, what I've got written on this chart is a way to play that game in a way that you don't have to sit and chart watch. Now, I will give you a warning that this type of setup that I'm about to explain, it's not a guarantee because for all you know, this could be a move up, a higher low, and we move up into higher prices. So it would only be if you're A, willing to take the risk on getting a potential swing trade entry, and it would come on the belief that you really believe that this was the high and we're going down from here. This is why you have to practice correct risk management because there's no guarantee that you're going to be right. And because this is set and forget, as price moves up and picks up your entries, it could just keep going and you end up getting stopped out. But if you have good risk management, it doesn't matter. So the disclaimer is that you have to be willing to take the risk and you have to believe in your own technical analysis that this is a peak formation and we're at least going to pull back from here. So here's how it works. Once your peak formation is in, price should pull away. Ideally, you want the candle after the peak formation to be also a vector because that just makes it very, very clear as to where you don't want price to return to because that's a high volume area that would have trapped a lot of traders. And if price returns there, then the market maker is releasing those traders, which means we're probably going higher. So in an ideal world, you don't want price to come back to this magenta vector that you're seeing on the screen right here, or it can come into it, but not all the way back to the top of it. So this is on the idea that you believe price won't come back into that zone. Once the peak formation is in, price will pull away and start to form what is going to end up being the inside of the M. And then once price has created that inside left side, it should start to move out to then start the inside right side. So you have to wait for this start to happen. As soon as that's happened, you can take your Fibonacci tool and draw it from the top of that peak formation to what you believe is going to be the center peak of the M formation. And then you have your fib levels here. And it's a matter of, as price comes up to create the inside right side of the M formation, you stagger your orders at each of the fib levels. So the 38, the 50, and the 61. And once you've done that, as price is creating the M, you've got a set and forget entry over each level, and price will just pick them up on the way, end up giving you an average entry somewhere in the middle. And now you're in for the short position. And if you were right, price will then move away from that. So in this example here, you can see that the first order would have already been picked up. Now this one I adjusted a little bit because the 38 fibs was here, which is where price actually went. So this order would be in already if you were actually doing this method. But I did put this order a little bit lower because that was yesterday's high of the day, and that's more significant than 38 fibs. So somewhere around 38 is fine. The next one is at 50 fibs. And then the third one lines up with a liquidation level, a newly created one, which is at 31,037. So that's a very interesting level to me, and I would really like to see price actually return to this, take that out, then move away for the M formation. That would be a good setup to me, depending on what the candles look like at the time once it got to that level. But once you have your three levels drawn on there, and then if we mark out the levels of just this magenta candle here, you can see that the 50% area of that magenta candle is around this liquidation level. So that's just going to be a great rejection. If price does get back into this 31,035 kind of area, if price can make it back there and look weak, I really do think we'll go down potentially in US, but it's really dependent on that final trigger. Just remember, whenever you're doing technical analysis, there's two parts to it. You have your setup, which is what I'm explaining to you now. This is a setup. Then you have your trigger, and your trigger is always the final decision. So you can have this as an idea in advance. Your setup is an idea in advance. Your trigger is like your confirmation that says, yes, that idea I think is going to play out. So now I'm going to enter. So the trigger, if price were to get back to this area right here, would be that the candles start to look weak. They start to look bearish, potentially inverted hammers, railroad tracks, things like that. If you had that around there, then you'd be pretty confident that what we're getting now is an M formation. And look, we have a news event today as well, coming up in a couple of hours. We've actually got core PCE, which is a pretty big news event as well. So it could be that, plus we have the monthly close. Like it's a significant day today, and price is at a very key area too, where it's rejected many times on the daily time frame. So if you are looking to trade something like this, be sure to check out the links in the description of this video, because I've got some exchange discounts and sign up bonuses and things for you down there for some of the exchanges that I personally trade on. And if you're looking for somewhere to trade, you can grab those links from there. And it's also a nice way to support the channel for all the free alpha that we give you guys. So back to this strategy. So now, you know, once the middle peak of the M is formed, you can stagger your entries here. The correct stop loss placement for something like this would be just above the peak of the first M, because if price goes higher than that, you're wrong. So you don't want to hold on to it for too much longer. You just want to be out, and you'd have to calculate your risk based off the middle entry and your stop loss there. Now, in this example right here, I actually have put the stop loss a little bit higher. That's simply because there is a liquidation level just above this, and they could come for that before they reverse. And there's also a vector candle that is not yet fully recovered right there. So I have given a generous stop loss up here, but if those things weren't there, your stop loss could be just above this peak here. So somewhere at around, say, 31.30 would be fine in a normal example. And then the final thing is, if price doesn't make it all the way up to the top entry, and let's just say only two of your entries get filled, then the way that you manage that, because now you wouldn't be fully positioned, right? You'd only have two of your entries, price pulls away. It's going to pull away to create the right side of the M, if we're correct on this. And the right side of the M should break the 50 EMA with volume. So once it's done that, it should then come back to retest. And this point right here is where you would then add the rest of the position that you didn't get filled the first time. And then from there, again, providing you picked it right, the price should fall away from that point. This is a really good set and forget way that allows you to get an entry once you see a peak formation is formed. You can identify your 3-level rise. You know it's in an area where price should turn around. Could be a news event coming up, a midweek reversal. You've just identified the 3 levels, any of those reasons that price should turn around. This is a good way to set and forget. And often if I see a peak formation, and let's just say it's right before my bedtime, this is how I will set up my entries overnight so that I can get my position and not have to actually stay up late for it. So as far as the actual price action and not this strategy, that's what I'm looking for right now. And I am conscious conscious that it is the weekend trap being Friday. The weekend trap is usually set at the start. So see here at the start of UK, price had this move up here. It usually repeats whatever move UK opens with. So I'm kind of hoping that we continue to trend, considering the move was up at the start of UK. We'll trend for a little bit, usually halfway through UK till about 8 a.m. New York. Price consolidates, doesn't really do too much. And then at 8 a.m. New York, you get a final burst, which if you have this indicator, it's already marked what would be 8 a.m. New York in this turquoise kind of color. If you don't have this indicator, just go search market session times on TradingView up here in indicators, and it's by us, Trade Travel Chill. So you can add it and it will automatically be right, and it will show you here that at 8 a.m, somewhere around 8 a.m, you'll expect another burst. So for all we know, this could do this and give us that burst at 8 a.m, which would be great. Then price pulls away, then US gives us a lower high, then we go down. That would be fantastic if it worked out that way. But the problem with being a Friday is that US is very, very tricky as far as how it creates the trap. So sometimes it can continue UK's trend, sometimes it can reverse it. So just be aware of that. It is a day where it is highly likely for your trades not to play out. And if you're willing to play the game anyway, then go for it. But just know that you're trading on a high risk day. In addition to it just being a normal high risk day, we also have core PCE coming out. And core PCE is a fairly big news event that usually does cause some volatility. So yeah, that's what I'm thinking. I'm still waiting for confirmation that this is over and it's going to go down to the downside. My longs are open until I have that confirmation. So we're good either way. So if you just learned something new, be sure to smash that like button. I would highly appreciate it. Let's take a very quick look at ETH. ETH is exactly the same. So see here, we've got the red candle. This is a bearish candlestick structure. It's not quite a stopping volume candle, but it's a bearish structure right here. Price has failed to return to it yet. It's probably also failed to return to 50% of it. Let's check. Yes, it's only just this candle right here wicked on 50% of it. So unless price can get back above that and then break above this, we should be looking for lower highs at this point in time. And that may only give us just a pullback. It doesn't mean that this run to the upside is over just yet, but we also don't have a guarantee that it's not. So that's why I think it's intelligent to hedge your longs at this point in the structure, especially if price can't get back into these vectors on both of those things. So if you were using the exact same strategy on ETH and you were drawing your fibs from the top of the peak formation to the middle of the M right there, you would have had your 38 and your 50 entry already in, and you'd be waiting to see if you got the 61.8. I hope that was helpful, guys. I'm going to leave it there. Have an amazing weekend, and I will see you guys next week.